Hey everyone, good morning. Marty Missouri here. Wanted to spend just a brief few minutes with you updating the charts and talking about current conditions just a bit. The 1-year daily candlestick chart for the S&P 500. I've identified this range in here with these yellow lines. Just seems to be where the bulls and the bears are doing battle. Notice that's a range where they traded back and forth back up in here before the market broke out, then peaked, and then we had that amazing correction in the last quarter of last year. You've had this nice rally off of that. Here's that pattern I've been showing you that's virtually the same kind of pattern that we had up here. These patterns you tend to see breaks below. Saw that here. Now we've found support back here at this very important roughly 2800, and again bouncing between here and there today, testing this this resistance as I speak. So as you've noticed, no doubt, in my commentary, I am a bit skeptical about this rally right in here based on the conditions in terms of the trade situation that I've been writing about for quite some time now. Also, the technicals are showing some waning momentum. We're seeing that here in the MACD, this momentum indicator, just like we saw it back here. Relative strength, we had a bearish divergence there. We didn't get that here, although we are trading in a range where recently that has been where the market has struggled. That's below 50, as you can see in here. This doesn't mean a whole lot, just means again that we have waning momentum in here. So no doubt there are shorts resting above that line, folks, anticipating that it's not going to hold. If indeed we go barreling through there with some momentum, well, then those shorts will be inspired to cover, and that can exacerbate the upside. So we absolutely could see some momentum up in here. I could very well be wrong about my short-term assessment of where the market's going. And then if we get up through here, no doubt there'll be shorts having to cover if we move through there aggressively with some momentum. I'll be very surprised if that happens in any sustainable way until we get to a no tariff solution or a no tariff agreement on our ongoing trade disputes. So for now, what we have is we have this trading range. We're at the upper end of this range right now. I would say right now, as we sit here today, that odds favor that we break down below that range. As it relates to what I'm concerned about, I've expressed that I think that would be a good thing because that seems to get the powers that be's attention. And it appears of late that maybe that's what's going to take to actually get to some real long-term decisions that are in the right direction as it relates to trade. Not that we don't have issues. I've written about what the issues are. I'm convinced that there are better solutions, as is pretty much the whole retail sector, if not the whole business sector, if you will, of the U.S. economy. This morning, the president got a letter from 174 retailers pleading with him to get rid of the tariffs, that they're beginning to do some real damage. Then they suggest, quote, that it will be catastrophic for them if this continues. I agree that general conditions will not hold up long-term amid a tariff war. Right now they're fine. I'm still constructive on the long term, which is why we're not making any moves to our long-term allocations. However, on a short-term basis, I do think that odds favor some more downside before we really find a bottom with this pullback here and start moving sustainably into all-time highs. I'll leave it there for now. Thank you as always for watching and listening, and I'll be back again very soon. Take care.